Here we are. We're online now. We're having a conversation here. You caught us mid-conversation. That's okay. Hey, this is the last lecture before the exam, isn't it? Right? You guys ready for the exam? Over chapter 12, 13, and 15, right? Pardon me?
The what?
The what? The exam. I gave everybody a test review sheet last time, I believe, right? Yep. Hey, one thing I wanted to point out, I think I told you a few things about tests last time, but I didn't talk about multiple choice. Do you guys, some people hate multiple choice. Do you guys like multiple choice or hate multiple choice?
Love Johnny.
Some people don't like multiple choice because they say, I would prefer problems. Well, try to treat multiple choice as problems when you can. What do I mean by that? For example, if it says the interest amount accrued, on this sort of investment would be, don't even look at the answers. Just act like you have to compute it, write out your answer, and then see if there's options that match your answer. Does that make sense? Or even if they ask you about a term, if they say the preemptive right of a stockholder is, before you even look at the options that they give you for the multiple choice, ask yourself, okay, what do I know about the preemptive right of a stockholder? Remember the preemptive right of a stockholder? That's the right, if the company issues more shares, for you to buy the percentage that you currently own of those new shares so you can maintain your percentage of ownership. And think through it and then say, okay, now that I've kind of talked through it in my mind, let's look at those options and see if one of those fits it. Okay? The other thing is, if it ever asks you for a journal entry, like have you ever seen those questions that say, the journal entry to record purchasing a short-term investment for $500 would include, and you know how the options are like a credit to this for that, or a debit to cash for this, or you've seen those? Don't even look at the options. Just make the whole journal entry. And then once you've made your journal entry and you're happy with it, look to see which option or options match up with what the journal entry you did. Too many people try to shortcut it. And they go, I don't want to write down the journal entry. Let me just look at it over here and I can just think through it in my brain. Not a good way to do it. Okay, write out the whole journal entry and then look for the options. All right? But the test will be, well, you all know. And this is what the test is next time we meet. And you folks at home, you know the last day that you have to take that test by. Make sure you look at the testing center hours. Make sure you don't wait until the last minute and then send me an email about, oh, I can't get in, my child was sick. If you wait to the last day and there's no margin left, that's going to be too bad, okay? You get 15 points extra deducted for every day late beyond that due date for you online folks, okay? So leave yourself some margin. Don't take it on that final day if you don't have to. Okay, cool. Let's go through the homework. I believe I assigned a couple of handouts, is that correct? Okay, let's go through those. Okay, let's do Oatman Company first, all right? Let's do Oatman Company first, all right? On March 12, 2014, Oatman Company purchased 250 common shares of International Bakery, Inc. as a long-term investment. The purchase price was $37 per share, and the broker's fee was $125. On January 31st of 2015, Oatman Company received a total of $187.50 in dividends. On November 27th, 2015, Oatman Company sold 150 of the shares for $28.75 per share with a brokerage fee of $60. Make journal entries on the following day. Okay, so on 3/12 of 14, what do? We debit long-term investments for how much? $93.75. And what do we credit for $93.75? Cash. Okay? Not too tough there. Okay? Now, on January 31st of 15, we receive some dividends, correct? We receive some dividends. Okay? So we debit cash for how much? $187.50. And what do we credit for $187.50?
Dividend revenue.
Dividend revenue. Very good. Okay. All right. Now, on 11/27 of 15, what happens? We sold 150 of the shares for $28.75 per share, and there's a brokerage fee of $60. Okay, before we make that entry, we need to figure out what the true cost per share was up here, right? So we spent a total of $9,375 for how many shares? For 250? Okay. If I do that in my head, I get about, $37.50. Is that right? Okay. So our cost per share is $37.50 per share. Is that correct? Okay, let's go down here with that knowledge and build our journal entry. Okay, well, our cost was $37.50, but we sold 150 shares for how much? $28.75. Okay, so we debit cash, but we don't debit for 150 times $28.75 because we have a $60 brokerage fee, right? First of all, let's just say, what's the number that goes here? Did you guys get it?
42.52.50.
Yes. It's 4252.50. Okay? How did we get that? Well, that is 150 times $28.75 per share minus the $60 brokerage fee. Is that how you got it, Henry?
Yes.
Okay. 150 times $28.75 minus that brokerage fee we had to pay of $60. Okay. So we didn't really pay it, they just withheld $60 from the cash we were going to get. Cool? Okay, so that's how we debit cash. Now we have to credit long-term investments. Well, what do we credit it for? We credit it for 150 shares that we sold times this cost of $37.50. And that is, I think that's 5625, is that correct? Is that right?
Yep.
Okay. Now, this is our journal entry. So far, it does not balance, does it? Okay. So we need help on the debit side. So since it needs help on the debit side, we are going to be affecting a loss on sale account. Right? A loss is like an expense account and has a debit balance. It's deducted in arriving at net income, correct? So what do we have to debit it for to make this journal entry balance?
$1,372.50.
137,250. Very good. So that's our journal entry. The other way that we know that we have a loss is our cost of the shares. Oops, you can't see that. This is how we got that number. Our cost of the shares was $37.50 per share, and we sold it for less than that, $28.75. You with me? Okay. Any questions on that? Anybody? All righty. Let's go to the next one then, which was Clemen Company. Kind of a similar one. On January 2 of 14, Clemen Company purchased, zoom in a little bit. Clemen Company purchased 600 common shares of Garmin Inc. as a long-term investment. The purchase price was $63 per share, and the broker's fee was $150. On December 31st, 2014, Clemen Company received $2 per share in dividends, and on December 31, 2015, Clemen Company received $2.25 per share in dividends. On July 24, 2016, Clemen Company sold 150 of the shares for $72.50 with a brokerage fee of $100. Make the journal entries. Okay, now first of all, let me remind you guys, we're talking about stock, you know, stock being purchased and stuff like that. The first thing you want to make sure you do on the test is make sure you are in chapter 15 gear and not chapter 13 gear, right? Here's the way my brain would go through this. I would say, okay, who are we in this example? Are we Garmin? No, we are Clement. And are we purchasing stock or are we issuing stock? We're purchasing stock. This is a chapter 15 long-term investment question, okay? And you'll see on the test, I took all the chapter 15 multiple choices and put them together to help you kind of shift into that gear, okay? Okay, on January 2 of 14, we debit long-term investments. And you know, sometimes you'll put in parentheses, you know, who it was with. You don't have to. For $37,950, and we credit cash for $37,950. Is that correct? Okay, now I know we're going to eventually probably need the cost per share on this. How did we get that $37,950? We took 600 times 63 plus 150. Is that correct? Okay. Okay, so we paid $37,950 for how many shares? 600. So the cost per share is $63.25. Is that correct? Okay, we'll come back to that later. But that's our journal entry. On 12/31 of 14, we get some dividends, right?
Oh, yeah.
How much? Well, we get $2 per share, correct? So what's 2 times the 600 shares we purchased? We debit cash, we credit dividend revenue. You with me? Okay, on 12/31/15, we get some more dividends, don't we? This time it's $2.25 per share. Well, how many shares do we have? 600. What's 225 times 600? It is it 1350?
Yeah.
So once again, we debit cash, we credit dividend revenue. Cool? Okay. What happens on July 24 of 16? We sell 150 of the shares, right? We sell 150 shares. What price do we sell it at?
$72.50.
$72.50. But then we also have to pay out $100 for the brokerage fee, right? So that equals 150 times $72.50 minus 100. Help me out here. I think that equals 10,775. Can anybody back that up?
That's right.
Okay. So we debit cash, and of course, okay, we debit cash for the 10,775. Okay. Now we have to credit long-term investments. This is Garmin. What do we credit it for? We need to reduce it because we no longer have some of these investments. We sold them. So we sold 150 shares, but we take the 150 shares times the 63.25 cost. Correct? And that equals, did you get 9,487.50?
Yeah.
Okay. Well, this is the journal entry we're trying to make and balance, but that doesn't balance, does it? Which side needs help? The credit side. So since it's a credit side, it's going to be a gain. Gains are like revenues. They have credit balances. They're on the income statement. They're added in arriving at net income. Okay? We also know it's a gain because our cost was $63.25, but we sold them for more than that, $72.50. So we credit gain on on sale. You could say on sale of long-term investment or just gain on sale, whatever. And what do we have to do that for to make it balance? 1, 2, 8, 7, 50? So that's our journal entry, isn't it? Cool? All right. Okay. Any questions on that, folks? Let's go through 15.8 real quick. Okay? Let me put that up on the screen. You can show that while I'm talking. Okay? Okay, this is 15.8. I like this one because it kind of makes your brain shift back and forth between the equity securities and the debt securities, doesn't it? That we might have in our portfolio. Okay, you know what a portfolio is? Portfolio is like all of the investments together. Okay. Okay, let's take a look. All right, prepare journal entries to record the following transactions involving both the short-term and long-term investments of Cancun Corporation, all of which occurred during calendar year 2013. Use the account short-term investments for any transactions that you determine are short-term. Okay? All right, let's take a look. On February 15th, we paid $160,000 cash. We paid $160,000 cash to purchase American General's 90-day short-term notes at par, which are dated February 15th and pay 10% interest. And it says these are classified as held to maturity. We're going to talk about those classifications here in a little bit. Okay? All right, so this might be a good time when you want to put AG in parentheses, right? Since we're having a lot of different investments in this one problem. But we debit short-term investments and credit cash for $160,000. Correct? Next one. March 22, we bought 700 shares of Fran Industries common stock at 51 cash per share, plus a $150 brokerage fee. And this is classified as a long-term available for sale securities. Okay, you don't have to put that AFS, that stands for available for sale. But the amount of cash outlay here is 700 times 51, plus we had to also pay $150 for the brokerage fee. So we credit cash for $35,850. We debit long-term investments for the same. By the way, our cost, it's not a real clean number, is it? Did anybody calculate that out? If you take $35,850 divided by 700 shares, you get about $51.21, but that's rounded. We'll come back to that later. All right, what happens on May 15th? C. Received a check from American General in payment of the principal and 90 days interest of the notes purchased in transaction A. So we get our principal of $160,000 back, correct? But we also get our interest revenue. How much interest revenue do we get? Well, we take the principal amount of $160,000 times the 10% annual rate times 90 divided by 360, since it's a 90-day note. Okay? If you did it divided by 365, you maybe got a slightly different number by different couple dollars differently, and that's fine. They usually use 360 just so it's cleaner math. Okay, D. On July 30, paid $100,000 cash to purchase MP3 Electronics 8% notes at par, dated July 30, 2013, and maturing on January 30, 2014, classified as a trading security. Well, we debit short-term investments for $100,000, credit cash for $100,000. You with me? Okay. Let's go to E. On September 1, we received a $1 per share cash dividend on the Fran Industries common stock purchased in transaction B. Well, we had 700 shares, right? We got $1 per share, so we got a total of $700 in cash for dividend revenue. Okay? Cool? All right, F. On October 8, we sold 350 shares of Fran Industries common stock for $64 cash per share, less $125 brokerage fee. Okay, let's build that journal entry. Well, how much cash did we receive? We received $22,275. Do you know how we got that? Let me zoom in a little bit. That $22,275 is 350 times 64, and then we subtracted 125 from it. Correct? Okay, so we debit cash for 22,275. Now, we need to credit long-term investments, don't we? What do we credit it for? Well, what you could do is you could say we sold 350 of those 700 shares, and our cost was about $51.21. And you could credit it for that much, right? But it will be a little bit off because of the rounding issue. This is not a clean number. This is a long number, isn't it? Okay. So what they did in this example was they said, oh, well, look, we bought 700 shares for a total of $35,850, and we sold 350 of those shares. We sold half of them, right? So what they did is they just took $35,850 times that 1/2, and they got $17,925. Now, if you did it by taking 350 times the cost, and yours is a little different, that's okay. I don't care. Okay? And on the test, I'm not going to give you messy numbers. Okay? You with me? Does that journal entry balance? No. So we have to credit $43.50 to gain on sale of long-term investments, don't we? You with me? Cool. G. On October 30, we received a check from MP3 Electronics for 3 months' interest on the notes purchased in transaction D. Now, we're not cashing them in here, are we? We're just getting some interest revenue of $2,000, right? How did we calculate $2,000? We took the $100,000 principal times the 8% annual interest rate times, you could say 90 divided by 360 or 3 divided by 12. It's the same thing. But you get $2,000. Make sense? Cool? Okay. Any questions on the homework? Wasn't too bad, was it? Hope you all are doing your homework. You folks online as well. If you don't ever do your homework and you've just kind of watched me do it, test may not go so well, okay? There's a big difference between watching me do this stuff versus doing it yourself and being able to produce the answer. As I say many times, the best way to know if you are ready for a test is, can you get a blank piece of paper out, not look at your answers, and can you do the homework? Correct? Right? I do have a practice test out there as well. Have you guys seen that? Separate file with the answers. Has anybody seen it? I know you have, Henry. Okay. Okay, before we go on and talk about something else, I want to talk about these classifications that they discuss in this class sometimes. Now, I don't want to get real hung up on this, but I at least want to touch on it, okay? Let's see if I can get it out of that glare. Okay. Okay, first of all, let's talk about trading securities held to maturity and available for sale, okay? First of all, let's talk about held to maturity. Held to maturity securities, these are debt securities that you hold until they mature. That's why it says held to maturity, okay? Only debt securities can be classified as held to maturity, okay? Now, there's also these categories called trading and available for sale that we have been talking about, okay? Trading and available for sale, okay? Trading securities, there are frequent purchases and sales of trading securities. They are trading all the time. You can think about it, okay? Available for sale, those are not as actively traded. Okay, now granted there is some gray area here as far as, well, is it a trading security or an available for sale? And I really, at this point in your education, don't care that you be able to differentiate between those. But what I want you to know is this. First of all, debt and equity can be classified as trading and available for sale, but let's just talk about equity. If it is equity and you own less than 20% of the company, which is the vast majority of your investments you're going to hold, is you don't own more than 20% of the company. Okay, you probably don't even own 1%, right? I mean, that would be a lot of stock that you'd have to purchase. But if you own less than 20% of either trading or available for sale, you account for these investments in the manner that I've taught you and am going to tell you here in the next slide or two. Okay? You with me? Okay. I don't want to get real hung up on this though, because I think I said in the lecture that the majority of our lecture, I mean 99% of our lecture, we are assuming that we own less than 20%. Okay? Now, looking back at this last time, it says for less than 20% for trading and available for sale, we use this concept called fair value. This concept called fair value, and that's what we're going to talk about today. So let me switch it over to the document camera. This is something unique about accounting for investments. Non-influential investments, in other words, you own less than 20%. Non-influential investments are typically valued and adjusted to fair value or market value at year end. This is unique and would seem to be a violation of the cost principle. Okay? I want to think through that a little bit. You can come off that. Do you remember the cost principle? Does anybody remember it for accounting 1? Does anybody remember the cost principle?
Some of it has to be exactly what you paid for it.
Yes,
You have
good.
to state the amount for what you paid for it.
Yes, you guys must have good accounting 1 teachers.
Decent.
Oh, it was me, wasn't it? Okay, that's right. Okay. The cost principle states that you purchase assets at your cost, right? Like, let's say you purchase a used truck and you purchase it for $12,000. After you purchase it for $12,000, you write the check for it. You get it appraised, and it's appraised at $18,000. Boy, you got a great deal. Well, that's all good and fine, but what do you record the truck on your books at? $12,000. Not the market value of what your friend thinks it's worth, right? Remember that? And that truck stays on there at $12,000, doesn't it? We record things at the cost. If you look at your check that you wrote, it's for $12,000. The truck goes on the books at $12,000. You with me? Okay. Now, let's say you purchased a rare. It turns out it was a rare truck, and it really is popular, and they're not making them anymore. And it actually, unlike most vehicles, it actually, can you believe it, appreciates in value, which never happens with vehicles. Okay. And let's say it appreciates so it's worth a lot more market value than that, and everybody can agree. Do we adjust that cost of the truck on our books to that market value? No, we do not. We do not. The truck is recorded at the cost. And it stays at the cost, doesn't it? In this case, 12 grand. Now somebody might say, well, don't you depreciate it? Yeah, we depreciate it, but remember, depreciation is not our attempts to adjust to market value. It's simply spreading out the expense over a reasonable amount of time. Okay, you with me? However, for investments, we do, let's say our year end is 12/31, we do adjust our investments, these assets on our books, we do adjust those to fair value or market value. And that's what this slide is saying. That seems to be a violation of the cost principle, doesn't it? You see the difference? We do adjust it. Why do you think we do it for investments, but not for example, The truck. Why do you think we make this exception for investments? Anybody?
That's the same way across the entire board. That market value is gonna be the same for everything. Like you could say your truck's worth 18,000, and someone else could say it's worth 10,000, and someone else could say it's worth 13. But the market value is a like set number across the entire board.
Okay, I think you're exactly right. I'm going to clarify a little bit. Just like Jeremiah said, a truck that is used, if the four of us got together and tried to come up with a market value and we all wrote it on a slip of paper, what's the chances that we're all going to be the same? It's not going to be the same, correct? However, if my company owns 100 shares of PepsiCo stock and we want to know what its value was at 12/31/14, where are we going to go to find the market value of a PepsiCo share of stock at 12/31/14? We're going to go to the financial listings, right? And by golly, if it says it's worth $36 a share, then we're all going to agree it's worth $36 per share on December 31st, right? Does that make sense? So that's why investments are a little different, because you've got these supply and these demand curves working, and you can look at something like the Wall Street Journal or the business listings and you can say, well, this is what on that date it says this investment was worth per share. Does that make sense? And so it's a better representation of what the asset really is. Okay? You with me? Now, worst case scenarios, let's say you bought a bunch of stock at $50 per share. Let's say you bought 100 shares of $50 per share stock. Well, you'd have what, a $5,000 asset, correct? 100 per share. Let's say it declined down to $3 per share. Well, if you listed the cost there, that would not be a good thing, right? Everybody knows it's not worth that, okay? So you adjust to fair value. You adjust to market value. And if it goes up, you do the same thing. You with me? So we're going to talk about that. We're going to talk about that a little bit. Let's say Matrix, we're Matrix. Let's say our portfolio of trading securities had a total cost of $73,000 and a total market value of $74,550 on December 31st, 2015, which was the first year the securities were held. Okay, there's a $1,550 difference there, isn't there? Okay? And has it appreciated in value or has it declined in value compared to our cost? It's appreciated in value, correct? So, what do we do with that $1,550 appreciation? Well, we make this journal entry. We credit what is called an unrealized gain. Do you remember when we talked about a realized gain? A realized gain was realized and confirmed by an actual sale. An unrealized gain, and this will go along with unrealized loss too, an unrealized gain is not yet realized. We're not selling the securities here, folks. There's no cash coming in. We're not selling the securities. We're not getting rid of some securities here. It's an unrealized gain because it's not being confirmed by an actual sale. This is simply an AJE you make to adjust it to fair value. Are you with me? But it is a gain, so we credit unrealized gain and you debit what is called fair market or fair value adjustment. You with me? Now the question is, all right, well that's the journal entry. What financial statements do these accounts appear on? You with me? Well, the fair value adjustment, and we had an appreciation in value this time, would look like this. We would show the cost right here. Let me get my pointer. We would show the cost of $73,000, but since we have an unrealized gain, we actually add that $1,550, and then we get our long-term investment at market. Okay? Now, if there was an unrealized loss, we would subtract it. Does that make sense? But then the net effect on this balance sheet is we are recording this investment at market. Cool? Well, what about this other part of the journal entry? The unrealized gain. Where is that recorded? Well, it's reported on the income statement if the investment is considered a trading security with frequent purchases and sales. Remember when we talked about those categorizations? So it's reported on the income statement. The unrealized gain is recorded on the income statement as an addition if it's a trading security. However, if that is classified as an available for sale security, which are not actively traded, we actually do not put it on the income statement. We put it in the equity section of the balance sheet. Are you with me? Now, I don't want to get too hung up in where do you put that unrealized gain. And to be honest with you, there's a lot of discussion going on right now about some of those rules. And the main reason that the discussion is being had is because some other countries other than the United States do it a little differently. And so they're actually, as we speak, there are people having discussions about if this is going to change. Are you with me? So I'm really not going to get too hung up between whether you classified that unrealized gain on the income statement or in the equity section of the balance sheet. Okay? Because that's a fluid topic right now. But what I want to do is, let's look at exercise 15.7 together. Exercise 15.7. Go ahead and take a look at that. Who's yawning? I hear somebody yawning. Is that you? Have another cookie. Did everybody get a cookie? My cell phone rang, so I had to bring cookies for the whole class. Has anybody else's cell phone rang? Mm-hmm. Luke's, yours did, didn't it? And you brought cookies. You're a good man. All right, let's take a look at exercise 15.7. We're going to do it real quick as a class, and then I'm going to have you do one real quick. Okay? All right. On December 31st, 2013, Ruggett Company held the following short-term investments in its portfolio of available for sale securities. Ruggett had no short-term investments in its prior accounting periods. Prepare the December 31 adjusting journal entry to record these investments at fair value. Okay, first of all, you don't adjust each security to fair value. You adjust the whole portfolio as a whole to fair value. Does that make sense? So what you do in this situation, it's pretty simple. You take these securities, you add up the costs to get a total cost of $246,700. You add up the fair values to get a total fair value of $237,600. And has it appreciated or declined in value? It's declined, hasn't it? So we have an unrealized loss in this case. An unrealized loss. And we would credit fair value adjustment. And this fair value adjustment would be subtracted from your cost on your balance sheet. Okay? I don't really care that we have the big discussion about where this goes, but it does go on equity since it's available for sale. Yes, Jeremiah?
Is a fair value adjustment, is that a debit balance account then?
Well, it can be either.
So it doesn't have like a normal balance?
It doesn't have a normal one. It's a good question because sometimes we debit it if there's an unrealized gain. Sometimes we credit it if there is an unrealized loss. It's either added to the asset or subtracted from the asset.
What kind of account does that make it?
Well, I guess you could think of it as this. When it has a debit balance, it's like an adjunct asset. When it has a credit balance and it's subtracted, it's like a contra asset. Does that make sense?
Okay.
But it's kind of like, the nearest thing I can think of is, do you remember the cash over and short account? Mm-hmm. Remember how if it had a debit balance, it was an expense, and if it had a credit balance, it was a revenue? So if you say, well, what type of account is a cash over and short account? Well, I can't tell you it's a revenue or expense. It depends on what the balance is. It's a great question, though. And the fact that you asked that question means that you're a good accountant, because you should always ask, what kind of account is it? Where does it go on the financial statements? Okay? Good question. But it depends on what its ending balance is. Cool? So that is our journal entry. Let's take a few minutes, and it won't take you long, but let's go ahead and do exercise 15.9 in your books. Exercise 15.9. I'll go ahead and put that up on the screen. Okay? This one right here. Exercise 15.9. Okay. And they can play that wonderful music that you love so much. Okay, I won't read this to you since you just read it yourself, but what you do is you simply add up the total cost of this portfolio. You add up the fair value, which you'd get from Wall Street Journal or whatever, and has there been an appreciation or a decline? Another decline. The fair value is less than the cost. So once again, we debit unrealized, not realized, unrealized because it's not being confirmed by sale, an unrealized loss for $850, and we credit a fair value adjustment for $850. Does that make sense? Okay. Make sure you are shifted into the Chapter 15 mode. Now, all of this is buying bonds and stocks of other companies, right? That we hold as assets for the reasons that we talked about in the first slide, motivations for holding investments. Make sure on your test when we're purchasing treasury stock, that's when we purchase our own stock. Is that a Chapter 15 subject? No. Remember how I said treasury stock is not an asset? Treasury stock is a Chapter 13 subject. Okay, I know I have a Chapter 13 treasury stock problem on the test, so I don't want you to be shifted into Chapter 15 on that. Cool? Okay, a couple more things, and then we'll call it a day. First of all, we'll go over Chapter 14 is the next chapter that we're going to cover. You folks at home, remember to look at your online assignment for Chapter 15. Okay? Chapter 15, let me be more specific. Your Connect assignment for Chapter 15. Look at the due date and when that is due. You folks look at your due date as well. Before I forget, in your slides, you might have this Appendix 15A about investments in international operations. You're not responsible for that at all right now, and I haven't had any homework over that. But just to answer any questions, go ahead and keep that because we might come back to it later. Okay? You with me? But the last thing I want to touch on is this. This is all a very complicated subject as far as dealing with investments, okay? And we talked about the majority of the cases you own less than 20% ownership, okay? Well, I do at least want to mention as we close, what happens if you own more than 20%? What do you do of stock? Okay, you own 20% or more of the stock. Well, if you own 20 to 50% of the company as an owner in equity, you will learn eventually in your accounting career about what is called the equity method. I don't really cover it in this class. It's more of an advanced topic. But the equity method is a slightly different way of accounting for your investments because you have that 20 to 50% ownership. What you actually end up doing is increasing your asset for your percent share of their income, things like that, okay? And if you own more than 50%, if you own more than 50% of a company's stock, you are in control. You are going to win every election that company ever has at the board of director meeting. Are you right? Because you own more than 50% of the shares. Well, in that case, what you do is you have controlling influence and you will do a consolidation. You will actually bring that entity into your fold and you will show the results in your company financial statements, okay? And doing a consolidation is a very advanced topic. As a matter of fact, it was covered in one of my final accounting classes in my bachelor's degree called Advanced Accounting. But you will do a consolidation if you own more than 15%, or more than 50%, okay? So I'm just kind of bringing those up, something to look forward to if you get your accounting degree. But like I said, in these examples, we are over here. All right? Any other questions, folks? Do well on your test. We will start Chapter 14 after. And good luck, and we'll see you soon.